balances and leverage in forex trading market. Balances and leverages in forex trading market. In forex market, the balance refers to the total amount of money in your trading account, including any profit or losses from open position. Balances we're talking about in the forex market, balances refers to the total amount of money in your trading account, including any profit or losses from open position. What are open position? Your buy side, your sell side are open position. Your bearish position, your bullish positions are position. Your candle moving trend upward and downward, anyone you enter there, these are terminologies, they are all open position. So your balances are those balances in your profit and loss open position. So you are putting a position maybe on the buy side and the market is on the negative. You know, like last week I opened a position, about 3 positions, where the signal was going the wrong direction. I didn't put any stop loss. My account went to negative $601. I will show you the account because I had to snap it so you believe what I'm telling you. My account went to negative $600, and that's my account went to negative $600, came back to profit. Came back to positive. You know, so those ones were not signal trading. They were my own calculation, my own risk model, my own permutation to enter the market, and I have my parameters for entering the market that pays me. So everybody has their own parameter. So as my students, there are things I need to teach you to make money, and as things you need to teach yourself. Then beyond whatever I've taught you, I didn't take a dime from you. I expect you to start going extra mile. Most of you have given you a particular website that says you go and open. They call it Baby Pips. Go to Baby Pips. You see different courses there. Open it and begin to learn. There's a lot of you that are going to be working in the Signal VIP group. By the time I see your seriousness, I'm going to give you a free link to be enrolled in a particular training class. That training class, you have access to about 63 videos that teaches all manner of things you want to know in Forex. Those are the videos of our partners. It's not free. It's about $1,000, but you will have access to it free. This training I'm doing it for you free, so you will have access to those videos free. About 63 video, minimum one video is about 1 hour plus, so about 1 hour 30 minutes. You have access to anything you want to know about forex trading, how to navigate beyond what I've just taught you, in just whetting your appetite to draw you into the class to learn and start making money. Beyond that, you can always gain access to it. So your availability, seriousness, and your ability to make sure you do what you have to do will go a long way too. So key points about balances. Balances, realized funds only. Your balances in your account are realized funds only and not funds of your open position, whether buy side or sell side. The account that is still trading. Because you know, when you open a trade, the trade you open, let's say you have $100, you are not, it will be foolish to trade with your whole of $100 because there's nowhere the market will be drawing liquidity from. So you open part of your trade by opening some percentage of your lot size. Let's say you want to do $2 to get $10, $2 to get $50, $2 to get $100. It depends on what you are looking at. Now, by the time you open that position, your open position that you're going to trade, your balance out of 100,000 is $98 minus $2. That your $2 is an unrealized funds that is still actively involved in the trading market, whether negative in profit, negative in loss, or positive in profit. It depends on what you are at the market side, and that's what determines. So your balancing does not entail that. It only shows you what your real account is, and that's why when you are trading, when you are losing money, your balance is reflecting it. When you are making money, your balance is reflecting it. What you lose, your balance cannot carry it. It has gone for it. What you gain, your balance will carry it. So it includes deposits, it includes withdrawal, profit or losses from all closed trade. So the only way your balance can reflect new money is when you close your trading position. Either you are in profit or you are in loss. Maybe you close it, it go out to your balance, and you have the accurate, the real balance. And that's why when you are seeing, when you open with XNET, you open with maybe INFS and other brokers, they'll be sending you statement of account. Today, this morning, as at 1 a.m., I saw my statement of account. All my trading I did yesterday, I saw the statement of account, my balances, my equity, my trading margin. All this I will be teaching you. Because it's important for you to know them before you go to the execution of the signals and co. That is the main core of this training, because they build up the particular location. So very, very, very important. So it does not include floating unrealized profit or losses from open trades. When I say unrealized profit, they are your floating balance. What are your floating balance? When you see your statement through your broker, there's something that is called floating balances. The floating balances are balances that are still actively involved in trade. You have not closed them. They could be in positive, they could be in losses. Whether they are in positive or they are in losses, they are what they call floating balances. So your floating balances are unrealized revenue, unrealized profit, unrealized losses that is yet to impact on your account. It's just showing on your trading volume. Now, by the time you close that account, you don't realize that the money just go straight. Now, for example, something happened yesterday. I've been carrying a floating balance on my account. I have an account of about $1,000. I built the $1,000, and I opened a position about 5 positions. Each of those positions was having negative of $150, $130, $120, and co. And at the point in time, I was having $601. Now, yesterday, the market changes. That the gold market that went up came to bearish, and the market came down. At the point in time, I felt that why am I carrying $600 that is not wise for me to carry it, and I decided to put my stop loss to take me off the market. That let me just start afresh in the new market. And at the end of the day, I closed the trade at a stop loss of $24. I closed another one $30. I closed down. Okay, there's one is still running. That one is in profit now. So I don't reduce my negative position, because I realized that with my analysis of the market that will be starting tomorrow by 11 p.m., the market may still not go my direction in the negative floating balances I'm carrying, or realized profit or losses I'm carrying. So now that the market has come my way, it's better for me to lose $64 than losing $600. So I closed the market. And let me say this to you, that market I closed, by the time the market opened, I was saving that money back. That's the way it works. So just imagine me as at that Monday, I was in negative 400 because I opened a wrong trade and I didn't put. I decided not to put stop loss. As at Thursday, I was already 600 negative. I was in 500 negative. As at Friday, same thing. Until yesterday night, yesterday evening, maybe around 8 p.m. And I put a stop loss when the market came my way, and 600 came down to about maybe $70, $80, and I put a stop loss. As the market was coming down in my favor, I just shot through of the market down at maybe $64 or maybe $60 and I'm fine, because it pays me to start and make that money by when the market is coming back than me carrying those buckets of negative and the market is not going my direction. So I close the trade back, and for me, I can tell you that by the time the market open, the market is going to open on a bullish trend. And that's $4 I lost. I can eventually make about $200 to $350. That's where the market works. But you cannot know anything. You cannot learn anything until you farabale. Like Yoruba will say, until you cool down and gain knowledge. Whatever you have known, whatever you have learned, cool down and let people that are in the market let you. Because FOREX market is so wide and so deep that a boy of primary school will teach you how to trade. And if you don't follow his direction, you may lose steam. Example, you deposit 1,000 into your trading account. You open a trade that currently is showing $200 positive. That is a floating profit. So your account cannot carry that profit until you close that amount. So you haven't closed it yet. You don't close it. Your balances is still 1,000. Even though your equity, which includes floating balances, is showing 1,200, but your real account balance is still showing 1,000. So until you close such trade, I can tell you that it will still be reading because your balances are the real money you have, not the one that is still trading and swinging positive or negative in the market. And that will take us to what we just discussed not too long. What is floating profit or losses in forex market? In the forex market, floating profit, also called unrealized profit, refer to the current profit or loss of an open trade that has not yet been closed. A trade you open that has not been closed is a floating profit. It's an unrealized profit. It's an unrealized loss. Your floating balances could be negative, could be positive. I told you about last week, about this week, as of yesterday, I was still carrying a floating profit of about $601. At the point in time, $630, $650. I was not carrying it. I was just like, wow. So if it were to be some of you, you'd have closed that account. You'd have put stop loss. Hey, account is burning. No, if you don't have heart, you cannot do this business. Just imagine I entered about 5 trades and I didn't put stop loss. Is it good? It's not good. Is it risk effective? No. But it's just a strategy that I've built over the years, and I believe that it works for me. I don't want to know what anybody is saying. So if you don't need to do it, because like you going to the express as a masquerade, but for me it works for me, and I know how to run the market to stay. So that's for floating. But since the position is still active, the profit or loss is not locked in and can change with market movement. So it's called floating balances. It's not your real balances. So a floating balance can be profit can be realized or unrealized. You open a buy position long in euro or USD at 1,100. Now the price moves to 1,150. You haven't closed the trade. You have your account balance to trade 1,100, while your floating balance, 11,000. While your floating balance still remain $50 because it's still hanging in the market yet to be activated on your account. So key points I want you to understand in floating balance: floating profit loss, the difference between the entry price and your current market price multiplied by your position, which is your lot size, determines your floating profit or loss size. It is only considered realized when the trade is closed. It reflects how much you could gain or lose if you were to close the position right now. Yesterday, I used myself as an example. I don't realize that I don't want to take any risk. Market is about to close. Now, if market close, do I need to still carry some bucket and baggages till next week? By the time the market open next week, maybe I'm doing some other thing. The market will not go my direction. I will not start carrying those bucket again this week because carrying that bucket of $600 plus, I could not trade effectively because I'm afraid of my margin balances. So it's very, very important for you to know what you are carrying. You have to be liquid to stay in business. Then the next point I want us to discuss is leverage in forex market. What is leverage? In the forex market, no, we have just discussed balances. We have discussed floating profit or floating loss. Now we want to discuss leverage in forex market. What is leverage? In the forex market, leverage is a tool that allows you to control a large trading position with a relatively small amount of capital. It acts like a loan from your broker, magnifying both potential profit and losses. So when we're talking about leverage, trading power or your capital is what we call leverage. That's to say, it is usually expressed in a ratio such as ratio 1 to 50. You can control $50 for every $1 you own of your own that you use to trade. You can control $100 with just $1. That's the foreign market work. Just imagine you have $1 and you're using $1 to get $50 in the market. You know why? You can control $500 just using $1 in the first market. You know why? That's what they call leverage. The broker use leverage to magnify the peanut you have to let you trade in large environment. So, and that is why when you are trading in using your leverage, if it goes to profit, you can make good money. When it goes to loss, you can lose large money. You can make large profit. You can make large loss. It depends on, because what you bring to the table is different from what the broker is offering you. Your broker is offering you pretty much pretty more than what you bring to the table. And that is what leverage is all about. So for every broker and every trader, when you open a position, just imagine they are selling gold for $3,350 US dollar, and you are having $100, and you want to trade gold, and you want to trade gold with $1. And then after they close the market, you make $50 by trading $1. That is not your money. What happened to you was that the broker only allow you to leverage by trading in large portfolio with your little money. That is how the forex market operates. Now, advantages and disadvantages of leverage in forex market. Now we have magnifies potential profit. We have the pro and we have the con. The pro, it magnifies potential profit. It magnifies potential losses. It allows trading with small capital, higher risk of margin call or account wipeout. Higher risk of margin call. I'm still going to teach you margin call, and we have treated, I think, risk there about last week, if I'm correct. If you have not treated risk, you can remind me so I can still talk briefly on it. Enables access to large market position. The disadvantages can cause emotional, psychological pressure on you, whereby you now begin to run helter-skelter. So we have come to the end of balances. You know what balance is all about. You know what we call floating profit and floating losses. And I've told you that your balances does not entail your floating balances. Your floating balances show that any position you open and you are still trading, any money that is still trading, positive or negative, bullish and bearish, is a floating balances. It does not reflect on your main account balances. You will see your main account balances, but that does not reflect. When you close the position, it's added up to your account balance. Then we now talk about leverage. Leverage allows you to open that position in the forex and trading market. Now I want to teach you what we call margin in forex trading. Margin in forex. All this I'm teaching you, you can still go and check it out online through Baby Pips and still learn until now. Margin trading is in the forex market. Allow you. I'm teaching you another course now. Please, when this time out, make sure you alert me so that we can come in again and we enjoy ourselves. Now, margin trading in forex market allow you to control larger position with a small amount of capital using leverage provided by your broker. Is one of the core features of forex trading and can amplify both profit and losses. So your broker gives you leverage and give you the margin to do what? To trade in a large position. What is the margin? What is margin in forex? Margin is the amount of money a trader must deposit to open and maintain a leverage position. Now, what is a margin? A margin is your trading capital that you put into a particular position. Let's say, for example, you have $100 in your account, $1,000 in your account, and you open a position of, let's say, 10%. That 10 lot size of $1,000 or 1% of 0.01% of $100. That's about $1. Now, when you open that position, that $1 that you plunge into the market to trade, either to buy gold, to buy Brent oil, to buy crude oil, to buy stocks of Tesla and Co, is your leverage, is your margin that you use to enter the market, that the broker enlarge for you to be able to position yourself in trading large volume of transactions. It's very, 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 very important. So it is not a fee or cost, it's a collateral. You put it inside and the broker enlarge it for you to trade. The broker temporarily loans you money so you can trade bigger lots. So the leverage you get it from the broker. Your margin is what you put into the market. It's not your balance. It's that thing you activated when you are buying a particular position, taking a particular position to buy. Your margin is held until you close the position. Your margin is held until you close the position. So you should not forget that once you enter a trade with $2, your margin is drawing from your liquidity position. Your liquidity position is your balances of your account. Let's say you enter a position with $2. Don't think that the $2 will be drawing money from the coven of darkness or drawing money from one babalawo or MMN. That money that you have used to enter the market, $2, 2 lot size. By the time your account is going negative, it will be drawing more money from your account balances to trade. The more you are losing, the more it's drawing money from your account balances and your liquidity position. Now, when you are making money, now it is going to draw from you. It rather increases your position. So when you lose, it draws. When you gain, it adds to it. But because it's a floating balance, it cannot reflect immediately at the end. It's not your own money because you are still trading. By the time you close it, it now reflects at the end of the day that is the exact money you have because you have pulled out of the market. How margin works in forex market? Let's say your broker offer you 1 to 100 leverage. This means you can trade $100,000 with only 1,000 of your own money. So imagine that your broker offer you 1 to 100 leverage. He offer you 1 to 1 of 1 to 100 leverage, or for example, he offer you 1 to 1,000 leverage. That's a lot of money. So that means that you are only trading 1,000 of your own personal money. You are trading $100,000. You are using $1,000 of your own money, but you are using $100,000. So when you open a particular position, what you are actually using to trade is $100,000, and you are just using $1,000 to do that transaction. The remaining $99,000 is provided by the broker. So the $1,000 is your margin, is locked into you until you close the trade. The 1,000 is your own money, is locked into you until you close the trade. Then key margin terms that we need to understand. We have use margin, the margin locked in active trade, free margin, what's left in your account to open new trades, margin level shows account health. It only shows in percentage. They will have margin call, broker warning when your margin level is too low. What is the margin call? A margin call, when you are trading, let's say you enter a trade with two lot size, and as a trading, your account is entering negative from $2, you have entered $60, $70, $80, and you are left with just $20. Your broker will send you an email. He will send you a text. Oga, what are you doing? The trade you open, the trade is going negative. Oh, your money will soon be wiped off. Oh, it's better you put a stop loss and close this trade, or you lose all your funds. So that's what we call margin call. You get it through text, you get it through email, you get it at time through phone call. When they realize that you are not acting, how do you act? By funding your account again. Okay, you are having just $10, you are losing $80. So let me add more money. You quickly go to your app, you transfer money to your account, you create your account, that your account enters. So your liquidity has now increased, has been topped up. To say what is going to $20 is now you just deposit $100. So instead of you losing money, you now have $120. So your margin and your leverage will now be trading to draw liquidity from your new money you have deposited in your account. So on this level now, your margin call will stop disturbing you. But if you refuse to take action, by the time your margin call gets to a certain level, the broker will close you out of the market. Then most of the time, the way the broker work is that if they realize that you open, let's say 1, 2, 3, 4 position, they will go and look for the biggest position that is drawing much of your liquidity. They will close it. They will help you close it on their own, and you cannot sue them. They will close it so that you stop drawing from your account to make you lose money. Then if they close that big trade and then that you are still going to negative, they will still look at the biggest trade. They will close it. The system will close automatically until now the trade that is not drawing much fund for you. Okay, then you can still manage to return back to the market, and so the broker can close your trade when they realize that you don't have enough liquidity, because they won't give you money to do those things. They're giving you a leverage, a very big position to trade. So that's the best thing you can do. It's like a loan of what you don't have, like what we call overdraft in bank. You are spending money you don't have in bank. That's overdraft. You don't have 100,000 in your account, but you are withdrawing 100,000 in your account. from the bank. That is the leverage the broker gives to you to trade. Then we have what we call stop out. What is stop out? Broker auto closes trade to protect itself if margin level hits 50% loss. So what am I saying? I just explained that to you, that a broker can stop a trade and just take you out of the trade just to protect themselves and to protect you if they realize that you are not taking action. I've told you I've lost $1,800 plus before. I didn't know what to do. I didn't have understanding. I'm telling you, nobody trained me. So I lost money. I lost $1,800. When dollar was 1,100. That's about 2.something million. I lost it because I have no knowledge. So you that you are gaining knowledge now is a plus on your side, that you are gaining, you are learning. And because you are learning, it's very, very, very important for you to learn and understand what you are learning, to take action. To do what? To take action. So we have what we call margin call versus stop out. I've explained that to you. You don't need to go back to it. Benefit of margin trading in forex market. Advantage and explanation. Trade larger. Access bigger fund. We're talking about benefit of margin trading in forex market. Volume. Position with less capital. Higher profit potential. More exposure. More potential gain. Efficient capital use. Keep more cash for either instrument. Now what we call risk of margin trading in forex market. Risk and why it matters. Amplify for the risk. Number one, it amplifies losses. Leverage work both ways. Small moves, big losses. Small moves, big losses. Margin call or stop out. Position can also automatically, without warning. The position can also close automatically without any warning. I've explained that to you. Then emotional stress, higher volatility can lead to panic trading, and all these things are very, very, very important for you to understand. Pro tips of free margin trading: use leverage wisely, don't max it out. Always use stop loss order. Monitor your margin level regularly. Avoid over trading. Keep enough free margin. Keep enough free margin so that your to close. Close of the matter, why we are here, the main close of the matter why we are here is to discuss on how we can execute order, how we can trade signal. But you know, all what I'm just teaching you is not because I don't want us to start going through the issue of waiting. Not to know something we are doing, you don't understand some terminology. So all the things I've mentioned to you, they are things I want you to understand. Use them. So when people are talking, you are talking like a professional trader. You're not just talking like a rookie or a baby trader. So you can talk and you can understand some terminologies. So where we are going now is the cruise of the matter. Now, and I'm going to explain it to you in a layman language. And I will now move straight to types of executional order. Now, when you approach a market, the first thing you learn is how to trade what I call how to trade signals. Now, when you talk about how to trade signal, you are talking about beyond how to trade signal. You have your app. You have registered with your broker. You have opened the account. You have started trading demo or you are trading real account. Whichever one you are doing, there are some things on the dashboard that is talking to you. I've told you some of them are candles. Candle is talking to you. The graph is talking to you. Figures are talking to you. Some figures by the side is talking to you, and that is the money of the assets you are trading. You see one in blue. You see one in red. You know what they are going up. They are fighting each other, dragging one up, dragging one down. That's the movement chart or price movement. They call it price movement on the charts table. So all these things we are talking about, they are things that you need to understand the way they work and you run with them. So the first on the list, when you open your what do you call it now? When you open your trading app, there are things you need to note. Number one, when you look at the bottom, the downward left hand corner, you will see we have 3 buttons there. One is a bot that want to tell you that what kind of candle graph you want to use. Is it line chart? Is it candle chart? You know, you can pick one. Most of the time, whether you pick candle, because candle communicates how the market moves to you easily. Then number two, you now see time frame. What does time frame say to you? Go and set your time frame. Time frame is telling you that you want to see how this market has been behaving since morning, a month ago, 1 week ago, 4 hours ago, 1 hour ago, 30 minutes ago, 5 minutes ago, 3 minutes ago, 1 minute ago. Once you click, let's say you click 1 minute, that 1 minute will tell you how the market has been moving. You see the graph in 1 minute. So that graph you are seeing is displaying how the market has been moving up and down, where the market gets to, where the candle stopped, where it return back again, you know, the bullish part, the bearish part, how the market came back and how the market fell. The candle is telling you based on time frame. So you can set your time frame to determine what you want to do with your time frame. Then beyond that, there is something you need to know that they call the market price. What is the market price? The market price of every trade you want to go into is very, very sacrosanct. They call it MP. Note it, it's being called MP, market price. What is market price? Market price is the price of the commodity you want to trade at the point of you trading it. The price of the commodity, for example, the price of Bitcoin as at now that we are talking could be 105,000 naira. The price of gold as at now that we are talking, let's say the market is open, not closed, is at $3,350. So the market price is the price of the commodity as at the instantaneous time you are talking. Then beyond the market price, there's something we call the EP. That's the entry price. What is entry price? The entry price is the price at which the trader wants to enter the market to buy or to sell, or the price at which you want to take a position, and your position could either be buy or sell. So immediately you just click your button and you buy, you have taken a position in the market. So that is your entry price, and the system lock it in that gold is $3,350. Mr. Oribo Ogunje entered the market at $3,349. So your entry price, at the time you click, maybe the market was 3,350. By the time you click, the market has dropped to 3,349. It has dropped by one. So that's your entry price is that price at which you enter. Now, when you enter the market, there is something you need to take cognizance of, very, very important, so you don't lose money. It's part of the risk management tool that you need to know. They call one stop loss, SL. They call the other one TP, take profit. Now, when you open a trade, it's expedient and important for you to do what we call risk management. How? By going to impute your stop loss. For example, you open a trade of $2, or just say 2 lot size out of your $100. You now went and said, okay, this trade I have opened, I want to make $50 in this trade I just opened. Wow, this thing is timing me out. Am I correct? At the market, you can say, oh, I've entered this market, I want to buy gold, I want to buy crude oil, I want to buy stock, I want to buy silver, I want to buy zinc, or whatever you want to buy in the market, as long as the market is trading it. Now, what you are buying, you are saying, I want to enter the market with 2 lot size. I'm having $100 in my account. So I enter the market with 2 lot size, irrespective of the margin and leverage the broker is giving me. I enter the market with 2 lot size. This my $2, I want to use it to make $30. However, I don't want to lose more than $10. Market, immediately my broker, immediately I enter this market at the market price and the entry price, and I've set that I want to lose just $10 in case the market goes against me. Now, if the market goes against me, just close me and take, as in when it gets to $10, just close me and take me out of the market. If the market goes in my favor, maybe I want to make $30 and I put my take profit there. Just take my trade profit and put my money in my account balance. So stop loss is a tool, is a risk management tool that you use to stop every losses you are making when you open a trade or you enter a trade. Take profit is a tool that you use to do what? To take profit in the market. You set it that when the market gets to this amount of money, you want to take the profit and come out of the market. And at the same time, it's possible for you to do what we call partial liquidation of your position. Maybe you are trading and you are on profit. You can partially liquidate your position and take out of profit while the trade is still on. Then meanwhile, most of the time, because I know this is the last class, I don't have time to start talking about this thing. It's for you to know, understand what I'm telling you. So I'm talking out of the books. I'm talking out of my notes. I'm talking out of what you may think you want to read verbatim. Then number two, when you are in a trade and you open that trade and the trade has entered profit, you can move your stop loss button to break even. What is that saying to you? That even if this trade goes against me, I cannot lose any money because this trade is started. I know every trade starts in negative, so the market will move to positive if it's going your direction. Now this trade is not in $10 profit, $15 profit. You have to move your stop loss to either entry point, or that's the entry point of the price. So when the market goes against you, whether you are not there, you don't lose any money, you can only lose what you have made. Or out of the $15, you can move your stop loss to take $10 profit. So that if the market is turning and coming against you, the market, when you get to that $10 profit, the market will just take your profit immediately and take you out of the market through your stop loss mechanism that you have set in place. Meanwhile, your take profit is still in the front. It's a futuristic tool that you are still pursuing to make sure that you make things happen. At the same time, we have a tool that we call lot size. What is your lot size? Your lot size is the percentage of your capital you want to use to buy a particular asset. And maybe a layman interpretation. Your lot size is determined by you picking a particular percentage of the market you want to enter into. For example, you have your $100. You want to enter a lot size of about 5%. That's about $5 out of $100. So that is what you want to use to enter as leverage into the market or as a margin into the market to trade. So as you enter, don't forget that the broker has given you a platform to trade beyond what you have. However, your lot size determines what quantity of your capital you want to use to enter the market. And that determines the quantity of the profit or loss you are going to make out of the market. And it's as simple as that. So we have told you that you can modify a trade. You can modify a trade, your trade while it's still running, to change the stop loss position or downward or take profit downward up. So as your trade is running, you can move your stop loss downward and you just modify it. You can move your take profit downward or upward, downward, anyone you want to do, and just modify. Then you can partially close a trade. Then the last one I need you to understand it before we go to different kind of execution order we have is the close order. The close order is when is an order in trade that utterly either because you are not satisfied with the position of the trade or you are making profit, you just close the order, you close the trade, and the market take you out of the market effective immediately. Very, very, very important. Then now, like I told you, we want to go straight to types of executional order in front of the market. Please, if you have not been writing, you need this one to write. Now, in our company, in our team, we give what we call daily signal. When the signal comes from the signal room of our partners, we say to you, you just go and execute the signal and make money. You don't go and making thousands of money, hundreds of money, dollars through us, through our signal and through our counsel that we are giving them. And they have been fine. Many of them make their salary, 1 month salary in a month, and they have been fine to the glory of God. So now what we are saying is that we want to discuss with you, because one of the cardinal points of this training is to teach you how to trade signal. Now, when signal comes in different format. Your own is to look at the signal and go to your dashboard and execute the signal. It could be instant signal, it could be pending order, It could be instant order, it could go to any kind of order. We're going to discuss them now. You just make them and make sure you run with them and you're fine. So we have types of electronic signal order in forex market I want to discuss. In forex exchange trading, there are several execution order types that traders use to manage their entries and exit in the market. Each type of order serves as specific support and purpose depending on the strategy, the trading strategy, market condition, and desired control over execution. Here is a detailed explanation of the most common forex trading execution order. Number one, market order. What is market order? A market order is an instruction to buy or sell immediately at the current market price. It's called instant execution order. So when you see signal we send to you and you see something like instant execution order, buy or sell order, it's saying to you that as you see that order, just go and jump inside the market straight. Don't look at any way, just go and enter the market straight and make sure that you are making money. Now, characteristics of this instant execution: no control over the price, over the exact price. Useful when immediate entry or exit is small. Important than price. Example: if Euro USD is trading for 1,150 and you place a market order, it will execute at the best available price of maybe $1,151 or $52, depending on when your hand clicks the button. Now we have what we call limit order. Limit order definition says a limit order is an order to buy or sell at a specific price or better. We have two types of limit order here. We have the buy limit and we have the sell limit. The buy limit placed below the current market price. The buy limit placed below the current market price. We're talking about limit order. Then the sell limit placed above the current market price. Their characteristics: only executes at the specified price or a more favorable one. May not get filled if the market doesn't reach the price. That it will not be able to trigger it when it's connected. Then we have what we call stop order, stop loss order. A stop order becomes a market order once a specified price, stop price, is reached. We have what we call buy stop, placed above the current market price. We have sell stop, placed below the current market price. Characteristics: used to enter trades in a momentum or breakout strategies. Also used to limit losses or protect profit. So the buy limit and the buy stop and the sell stop place order above the current market. The other one placed below the current market, and it's being used when we have the momentum of a breakout strategies that hits the market and move. We have number 4, what we call stop limit order. Stop limit order. A stop limit order combines features of stop and limit order. It becomes a limit order when the stop price is reached. Characteristics of stop limit order: more control over execution price. Risk may not be filled if price moves beyond the limit prices. Very, very important for you to understand. Then number 5, we have what we call take profit order. Take profit order: an order to automatically close a trade when the price reaches a certain profit level. You open a trade and you go and put your take profit TP at another level. When the trade gets to that place, the market will just close the trade and move on. The characteristics help lock in profit. Always paired with an open position. Can be used by any entry types. We have what we call trading stop order. Trading stop order is a stop order that moves with the market in your favor, but stop in profit if the market reverses. A trading stop order, TSO, a stop order that moves with the market in your favor, but locks in profit if the market reverses. So it's moving in the market when the market is making. When the market is reversing, it shut you out of the market. What is the characteristics? It trades the market. Number 2, it helps protect profit while allowing room for further gain. Then we have number 7, one cancel the other order. A combination of two order where it is one, where if one is executed, the other is automatically cancelled. What's the characteristics? Useful for breakout or reversal strategies. Combine a stop and limit or two different prices level all together. This is very, 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 very important. Number 8, one trigger, the other order. An order where the execution of one triggers another order or a series of order. The execution of one triggers the order in that order manner. We have characteristics used to automate strategies, help in managing multi-level trade setup. Now, when you look at all this order we have mentioned, the signal group will be sending you these orders. Most of the time, what you have is the instant order, and you have your instant order. You have the pending order. So, and the instant order is being determined immediately. The pending order is being determined when the price gets up or when the price gets down to the sell or the buy side of that same order. Now, on this note, I want you to understand that we have the duty to give you signal on a regular basis as long as the market opens, as long as the signal groups are working and the market is in our favor. Now, with this that I've taught you, I want to do what I call a kind of addendum or a kind of gift to the first and the second class. And what is that gift? There's something we discussed that we didn't discuss in full that I think we need to just discuss today. Now, most of the time, how the forex market works is working through information. It works through information. So we want to discuss major news or international information that impacts the forex trading market globally. And you need to begin to look for those news. And that's why when you look at baby pips, give you the news. Your broker to give you those news on your email. Except you don't go to your email to go and check. In forex trading, international news play a crucial role in influencing currency prices. Traders need to stay updated on both scheduled economic data, releases, and unscheduled geopolitical events. Here is a list of the major international news and reports you should always watch daily. For example, look at me. If you ask me now that what are the major international news that is trending beyond Nigerian news that can affect the forex market, number 1, I will tell you the war between Ukraine and Russia has got it to another level of uncontrol. Where they cannot broker peace easily because Ukraine went to bomb about half fleet of the bomber airplane of Russia, inside Moscow. And Russia too sent about 400 drones and 40 ballistic missiles to bomb Ukraine. And they were doing that in multiple cities. Number 2, the reason why the price of gold is going up and down is because last week, Donald Trump wanted to high price of tariff. Now it's time to come down price of tariff. Plus or minus, people now see those news as a technical safe haven to put their money, lock their gold in. So we see it as a point of, the trade tension is easy now. Let me take my money. That's why you see the kind of draconian movement of the chart in gold market on Friday. There are many of you that can do what we call the scalping or entry and exit strategy. You would have made up to $300 to $400 because the market came down from $3,390 down to $3,300 and maybe 20 something, or 30 something, maybe 31 or so. Just imagine that from that high to this high. If you're just entering and you're coming down, you'd have made a lot of money. So the news of the market affects the Then number 4, there's a trouble between Elon Musk and Donald Trump. Don't forget that they are the cryptocurrency pusher. Elon Musk and Donald Trump, they're pushing the cryptocurrency market during the election to support them. Now, Donald Trump has gone to Pakistan to go and meet the president of Pakistan. They floated a coin. A Bitcoin. They floated it in Pakistan last month. India was angry that how can we be floating coin with our enemy that just came to carry out terrorist acts in our country, and we just went to bomb them about 2 weeks ago. What am I saying? All these things, they are information that affect the market. So if you are trading in the Bitcoin market, it's a major information that you have to draw with. In the gold market, what is happening that people rush gold when there's an information that is trouble in the world market, tariff, bombing, war, they see gold as a very secure medium of saving their money. But when there's no tension anywhere, they come and move their money out of the stock market, and they are very, very fine. So, top scheduled economy news that we need to understand. Number one, interest rate decision and central bank speeches. Central Bank of the United States of America, Federal Reserve, Fed, ECB, BOE, BOJ, SMB, RBA, etc. All these news, their impact, interest rate directly affect currencies. What is trend? Higher rates typically strengthens currency, but when it comes down, it affects currency. Now, the Federal Chair Powell speeches, the President Lagarde, that's the European Union President, the BOA governor speeches, all these people give news. Just imagine that you play in the Nigerian stock market. Number one, you play in the bond market, you play in the which other market now? In the FOREX market, and they said the federal government of Nigeria to the central bank government want to make a proclamation on inflation, proclamation on lending rate, and you say you are not interested, and you have millions in bank, then they are doing you. The witches in your father's house they've gotten you. That's the meaning of that. So you must be interested in major in that. If there's an accident, if there's an explosion, when the issue of Fubara and Wike came up and they said they went to bomb some pipeline, is a major information to a forex trader that is trading in the local market to know that this thing will affect our Nigerian stock market. It will affect this, it will affect that, and that's very much. So the same way, you have to stay informed in forex market to get daily information on your broker page, on your baby piece I've sent to you as well. I'm going to share some of them with you to get information on CNN, on BBC, on Channels News, and on NTA, on Arise. All of them, they give international news too. We have what we call inflation report, CPI, consumer price index, all this information. When they come out, they always come out around, I think, Monday or Tuesday. When they come out, you see 3 colors, yellow, pink, and red. Anyone that carries red is a danger trade. That is to say, if he carries red, that means that anybody that went to trade that thing is going to burn his money, because people act on information. Number 3, news that you have to work with. That's what I'm saying for old class, second class, and this current class. We have what we call employment data in US, non-farm payroll. NF released monthly, very impactful to US. Unemployment rates, all major economies, jobless claims weekly for US. Now, what we call employment data, US release this information every week, every month, and they release it for investors to take decision whether to enter the market or not to enter the market, whether to go and invest the money in bond market or whatever you want to call it. That this information is an international report that American government shares in their country, and is all over the places in the internet, it's all over the places in social media that everybody can pick, and that guides to form decision. You can check that on artificial intelligence, and you can check that on any other news platform. We have what we call GDP, gross domestic product, indicates economic growth or recession. It determines news too. PMI, Purchasing Managers Index, is being released monthly by ISM in the US. It measures business activities and economy. Number 6, trade balances report. Trade balance report track import and export. Trade surplus can strengthen a country's economy. Now, we have what we call unscheduled geopolitical news. What are those unscheduled political news? These have immediate market movement potentials and are harder to predict. What are those things? Geopolitically, political tension and conflict, war, border dispute, terrorist attack. Example, Russia-Ukraine war, tension in the Middle East, East China, Taiwan issues. Then we have what we call political instability and election. Political instability and election. Now, on this one, unexpected resignation of the president, coup d'etat, election or government change, regime change, and co. Brexit exit, related development greatly affected the British pound sterling. Natural disaster and pandemic, earthquake, pandemic, COVID-19, COVID-20, major hurricane can cause sudden drops in affected countries' currency. Major corporate financial failure, bank collapses, Silicon Valley Bank in 2023, credit ratings downgraded, and US debt downgraded. All this thing affect the stock market on how people trade. OPEC announcement, oil price shocks, oil producing nation currencies, CAD, NUCs, RUB are sentiment. For example, now Ukraine has got to bomb Russia oil well. That is to say, the number of supply flow for Moscow to part of the world will be reduced. That what we call underwater cyber destruction and cyber terrorism. People will now say, okay, because the cyber cable that carries internet data comes from abroad. Some of them pass through international sea water. Some can go and bomb them. Like during the Ukraine and Russia war, one of the parties went to bomb that cable. And because you know it, there was trouble all over the world on this matter. Now, OPEC news on fuel, petrol plays a major role to determine where the market is. How to stay updated daily? There's some particular site you can go to get information. Number one, FOREX Factory. Notice this one is the best. FOREX Factory. We have investing.com. You can write it down. FOREX Factory, investing.com, trading view, calendar. All these things will give you regular updated information. Set alert on your trading platform. Most platforms allow you to be notified before big data release. Follow financial news. Bloomberg, Reuters, CNBC, Twitter, X for fast breaking news. And before you know it, you are very, very fine. Now, last but not the least, pro tips for daily forex trader. Always check the economic calendar before opening a trade, especially around. For example, now London open 8 GMT, New York open 13:30 GMT. This time see high volatility, especially if major news is being released. So if you are entering that market and you are not going to do your research to know that market is changing because of the news that has just been announced, you will burn your finger. You will burn it dangerously and radically. It's very, 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 very important that you don't burn your finger. So on this note, I've come to the end of the training. I've wanted to understand that your ability to start trading so that you don't forget what you have learned is very, very, very key and very, very, very important. I want to throw the floor open